And good afternoon or good evening, depending on where you are joining this webinar from. My name is Michael Filighera. I am the proprietor, trader, analyst with TradersHelpingTraders.com, LogicalSignals.com, and then I also have the Eye of the Storm Podcast.com. I also present and do two or at least one update every day on the S&P 500 and the NASDAQ 100. And a little bit about my history. I started here in San Francisco on the Pacific Options Exchange, and I was an options market maker. And I began in 1979. And I've also been an options market maker on the London Traded Options Market, the European Options Exchange in Amsterdam, and also the DTB, which is the electronic exchange from Germany. And then I returned to the United States, came back to the Pacific Exchange. And once everything started to go electronic at the turn of the millennium, many of us just left the floor as things began to slow down quite a bit. And then I continued to trade options, but I was doing it from my home office. And then at one point, about 2013, I guess it was, I decided that I was tired of the extreme overnight volatility and trying to position against that. And I became a day trader. So what I do now is I am a day trader in the futures markets, and I do a variety depending on what I am looking for or looking at. And my favorites happen to be the NASDAQ, the S&P, and gold. And then I continue to do analysis. And funny, because I did hear the end of Stephen's presentation, and I am an Elliott Wave analyst. And I have been doing Elliott Wave since 1988. So it's quite a long time. And I present every day an Elliott Wave update. So, but today, what I am going to be looking to talk about is defining your trade plan or your trade rules, and how do we develop a strong mindset, both of which I believe are in current markets extremely important. In order to either, it doesn't make any difference if you're a position trader, a swing trader, a day trader. Each one requires a defined set of rules, or a trading plan, as many people would call it. And to truly become, I believe, to be a successful swing trader or day trader, you have to develop a strong mindset, which keeps you in line with your trade plan and also the markets that you would happen to be trading. So just to dive right in, it's going to be very interesting because in about 27 minutes, we're going to get Apple's earnings. And so what I'm going to be talking about is what you would apply if you happen to be a trader and you're waiting for Apple's earnings, whether you trade Apple, whether you trade the Apple options, whether you trade the future, such as the NASDAQ or the S&P, all are going to react. Actually, the Dow future will react as well. All are going to react wherever Apple, whichever index Apple sits in, they're going to get a reaction because the stock obviously is going to have a reaction. And so let me kind of dive in and begin so that when we get those earnings, I'm going to flip over to a different screen, which is actually my trading screen. And I'll just show you that right off the bat. And that it's NinjaTrader. So these are my trading screens. And then I'm going to have the NASDAQ and the S&P, and we're going to watch to see what that reaction is going to be. And then I'll be able to also discuss mindset and trading rules and how we would then employ them as the market is trading. And because the future with the earnings, yeah, it will be. The earnings will be extremely important because you're going to see trading in action. And one of the things that I've always favored to do, even when presenting in a webinar such as this, is to actually use live screens, actually use live trading. It just puts what I'm saying into immediate action. And I think each one of us, as we develop ourselves, we develop our trading skills, we develop our mindset and our trading rules, we tend to run into problems. So let me begin with how I develop my trade rules. I think each one of us is going to have varied trading rules. And what would that be based on is your account size, your risk profile, and what your goals are. So in developing a trade plan, you kind of need to take a look at each one of those individual things. And so often I have people coming to me and they're discussing, saying, hey, I only have $5,000 and that's what I want to begin with. Can I trade the future? And my thoughts is like, well, yes, you can, but you're going to be very, very limited, because depending on what future you choose, you have to understand what that future is per tick, per contract, and et cetera, and how fast or slow it moves. And so you really, in part of your trade planning, is getting an understanding and knowing what the product that you're choosing to trade, how does it trade? How does it react to news? How does it react? Is it a part of an index that can get, when you're getting a buy program or a sell program that is selling all of the stocks within that particular index, how does that affect, say, for example, Apple, since that's the one that we're going to be discussing today? So it's important to understand with Apple that it is the heaviest weighted stock in the S&P and in the NASDAQ. And what does that mean? That means, as for example, in the NASDAQ, if Apple were to move, let's say 10 cents, it could be equivalent to $5 in the NASDAQ future. It could be equivalent to $1 or $2 in the S&P because of the weighting. And because both of these indexes are cap weighted, Apple, one of the largest capitalization that we have in the market today. So knowing that is going to give you a lot of forethought if you're watching the market. Now, you'll get from a lot of people that it's like, well, I don't really care what happens to the stocks. And that's going to be part of a mindset discussion. But in terms of what we're going to be looking at today, and we're going to be wanting to look at these indexes when Apple's earnings come out in 20 minutes. So it's understanding, what does that stock do to these individual indexes that I'm going to be looking at to trade? And so you're going to have to understand they're the heaviest weighted within them. And that means as it moves fast, these will move faster. And so with earnings, as they say, if it blows the doors off, you will see the NASDAQ go, let's just say, for example, they were to come out right now and they blew the doors off, it will go from 13,030 approximately, and it would probably go to 13,130, just like bam, up $100. So when you're trying to devise your trade and you're trying to look at your trading rules, understand that if the NASDAQ moves 100 points nonstop, and trust me, I've seen it do it in less than a minute, then it's $20 a point. So it's 20 times 100. It's a $2,000 move. And you've put on a trade. Maybe you decided, I don't think you're going to blow the doors off. I think I'm going to short it. So you short it at 13,030, and the order and the comes out, and it flips and it flies up $100. You're suddenly, per contract now, you're suddenly down $2,000. What do? How does that affect you? What does it do to your mindset? What does it do to your trading rules? So in developing that, we keep all of those things in mind. So my own personal trade rules and how I kind of try to coach or guide people and when they're developing them is number one, you have to have what's your trigger? What is going to trigger your entry? So your trigger is your entry. And there are a lot of different factors. Now, the one thing that, because again, I caught the end of Stephen's presentation, and I absolutely 100% agree, you don't want to over accessorize your chart. And accessorizing would be, it's like you've got, moving averages, you've got all kinds of different things. You got Bollinger Bands, you got this, you got that, and everything. And suddenly you can no longer see the candles. You can no longer see the price action because there's so many things over it. So, and then trying to determine what is your signal. Well, sometimes you're going to people say, well, if I get this one lining up with that indicator, lines up with this indicator, lines up with that one, I take the trade. Usually by the time that happens, the trade's done. The trade's over. You missed it. So you're either getting in late. So determining what your trigger is. And say, for example, one of them for mine, and again, on a very short term, I'm using a 2-minute chart, and that's where I will trade off of, because one thing that I love to do, I love to scalp. Now, that's not everybody's cup of tea. So again, when you're determining what your triggers are going to be, you're putting it into the time frame of the chart that you're watching. So that in other words, if you are a swing trader, then you're going to want to be looking at a little bit longer term chart, 15, 30, an hour. And you're want to take in reviews of the daily. So as you come in on the day, you're taking a look at the daily chart to try to determine, okay, where are we? How are we coming in? What did it trade overnight? Did it kind of move around? Or what could it have triggered, which would be more indicative of an upside or a downside move? So again, this is all but now determining, for me, on my little 2-minute chart, I like when the market, and I'm using moving averages. Now, the ones that I use, the ones that's all the way here on the bottom, that is a 5 period. So I set mine up. I also use Fibonacci. So I'm an Elliottician, and I also use Fibonacci sequence religiously all over everything that I do. And let me just explain why. That truly the markets and Elliott is based on and so is Fibonacci, the laws of nature. And since we as human beings, we are part of nature, we also fall under that law. Our bodies are constructed in Fibonacci sequences. And I don't want to spend a whole lot of time on that because I'm going to be taken away from many other things. But do understand, and it's worth reading about so the Fibonacci sequence starts at 0. And what he does is he constructed it by you're taking 0 and what's the next number? 1. You add those together. So it's 0, 1, 1, and then you have 2, and then and then it goes, 1, 0, 1, 1, 3, 5, 8, 13, 21, 34, etc. And you just keep adding the previous number, like the first and the next number up. So the 2 numbers previous, you add them, and then you get the next number up. And then you add the previous number, you get the next number up. And what Fibonacci realized as he did all of this, that the relationship, once you start getting past, 5, 8 towards into there, that they have a relationship. And then that is the Fibonacci sequences and the Fibonacci numbers. So you get 0.382, 0.618, etc. Now, what Elliott did when he came up with the Elliott wave principle is that, again, the laws of nature are applicable because we're human beings. And Elliott wave does not pretend to actually forecast or understand fundamentals or a lot of the different technicals that kind of come into the market. It really is measuring human emotional reactions. And that's always been what's the emotion going on right now? What's the emotion when we see a market suddenly drop quickly or run quickly? There's emotions that go along with that and help produce the moves. Now, it changes a little bit because of the fact that we are now a quantitatively driven market. It's not like we're individuals staying on the floor and we all have our emotions, we all have our thoughts. Everything's programmed already. You know, when they're coming in as a buyer and they got to buy 100 contracts, they just put 100 and hit buy and off it goes. And it'll do it without emotions. But Elliott continues to work because even through that, the person who constructed the algorithm has emotions. The people that are trading outside of an algorithm, we have emotions. Now, so what I'm doing here, my first trigger would be, I'm looking at, and I'm going to go over my moving averages. So the blue one is the 5. The yellow is the 8 period. The blue is the 21 period. And the kind of the brownish one is the 55. And then the one that I leave at its number is the 200, and that's the magenta colored. These are all EMAs. And as I go out further to a larger time frame, in fact, I can show you on these charts, I have, see this kind of the dotted, and it's also magenta. That's the 200 SMA. And as the previous presenter did notate, and it is very true, everybody uses those. A lot of people do use SMAs, but a lot of them use EMAs as well. And in fact, institutionals tend to go EMAs, but they include like a 50 period SMA, a 200 period SMA, 100 period SMA, because those are very commonly used. So back to using my moving averages. So here I am, I'm waiting, and I'm going to develop what my trigger is. If I'm going to go long, I want to see this market come up, go above the 8, tick up a little bit, come back, hold the 8. So it's got to break above the 4, break above the 8, and then I want to see the 4 start to hook. So you'll see as it moves up, it'll actually hook. It'll produce a hook here, and it'll head up. And the same thing will happen to the 8, and then I'll buy it. So my next step is, okay, now you're in. What's your goal? What's your target? So those two words are interchangeable. And initially, as I just said, I love to scalp. So what I really look for, as a minimum, I want $100, $100 on the trade. That's what I want to make. So you can equate that to how far does this market has to move for me to get $100? It just has to go up 5 points. And you'll notice it can do that pretty quickly, as we just did it. We traded 37. Oh, look at that. Now we're going up. Bing, 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 bing. So you can see how quickly the market can go up. Those $5, 5 points, made you 100. I'm out. And then I'm going to see what happens. Now, others may use, when we break the 8, I'm looking for it to get to the 20 or the 21. I still use 20. I still use 4, 8, 20. Those are the more common. If I start saying 21, people get a little like, what? So, and then right above that is another, not necessarily an indicator, it is a volume profile. And within that volume profile, what we develop is the value area high, value area low, and the point of control. Understanding that the point of control is that place where most of the volume within this time frame has taken place. And that would be 13,047.75. So that is the value area. So this whole larger between these two is considered the value area. The point of control is that level where the market will go up to, come back down, go up through, travel maybe up towards the upper end of the value area. So that's value area high, and then retrace back down, coming back down. So this is how you would use these readings. Now, of course, they're open to change if we start to really move, which we could when we get these Apple's earnings, and we truly start to flip and we go up past that, it shifts it all back up. The point of control will then shift up because it will recalculate and then start to go to where the volume is now taking place. So we might see it go up, spike back down, and the point of control really won't move. So we have to wait for it to change, but that doesn't mean we cannot trade, because of course you will trade. So when you're monitoring and you're setting up your goals, or your targets, then you can continue to use the moving averages, because the theory goes, as they break, that the market is likely going to start moving up to. So if it broke above this 20 and then it broke above the point of control, the thought process is it should go up to the 50. A break here. Now this next green red line, that's the value weighted average price. That's VWAP. And that's used by a lot of asset managers, portfolio managers that come in and they're doing baskets of stock. And they may, if they're doing it on a VWAP basis, they already know coming in for the day that they have X amount that they need to buy, and they can divide it up by customer, or they can divide it up by, I'll buy so much here, I'll buy so much here, I'll buy so much here. And then they're going to report back to their customer via the value weighted average. And that's how, instead of saying, well, you bought it at this level and then here and here and here, they just put it in and then they evaluated average. So I keep an eye on that as well, because there's a lot of algorithms that tick off of that and use that. So it's a lot. The question is right away, do you have a fixed stop loss, or does it depend on the swing highs and low? I think that's a very good question. So step 3, right? So step 1 is, what's your trigger? Step 2, what's your goal? What's your target? Step 3, or rule 3 for me, is where are you going to get out of the trade if the trade becomes invalidated? And so that then goes to risk, and then goes to, if my goal, if I'm using, so if your risk profile, are you doing 2-to-1, 3-to-1, et cetera, et cetera? And you need to figure this out before you jump in. So again, I'm a scalper. So me personally, because I also have a number of years of experience, I have a stop, but I'm watching price action. I'm watching the levels. I'm watching if it goes against me, where did it fail? And so I know if I'm going to get out, if I'm going to hit it. But because my targets are pretty tight in terms of 100, that I normally don't have a stop in place. Now, if you're trading and you're figuring, I'm going to get in here because I'm believing that the stock's going to go to 13,070, then you also now have to realize, okay, where am I going to get out if the trade becomes invalidated? Well, what's going to invalidate that run? Run number 1, likely it already has been. But you might put it in on a break below that candle, or you might put it in if it breaks below 13,026, which is this current low here. Then you're going to want to be out of the trade, because it's obviously not going to go to 13,070. So that's where your stop is. Now, important level. I do have good VWAP numbers, yes. To be honest with you, the question was, do you have good VWAP numbers? Yes, I do. They're calculated by on this platform, which is NinjaTrader. You see, I have an order flow VWAP. So it's all set up by NinjaTrader, by this program that's on there. But yes, they are good. And there are other VWAP indicators that are available that are just as solid as well. So yes. No, you didn't. Apple's earnings are not out yet. They're due out at 4:30. So no, you did not miss them. We'll be watching Apple. See, we got Apple right there. The earnings are definitely not out, because this thing would be tripping and flying and flipping all over the place. So this is, I think, this is in our market here. We have our official close at 4 o'clock. Then they give an additional hour, so from 4 to 5, for asset managers, hedge fund managers, everybody else come in and do their business. You know, instead of trying to get it all shoved in there before 1 o'clock, they've decided that they'll give them additional opportunity. So maybe they put their buys in, now they're putting their sells in. So new money, redemptions, whatever you want to call it. Now, back to trade rules. Here's what I have found through all of the coaching time that I have done with other people. They get, yep, what my trigger is. That's my entry. They get, okay, this is my goal. And they get, this is where my stop is. But they tend to walk past their stop, cancel the stop, move their stop. And that's a big mistake. And normally now what's going to happen, why? The next factor that I was going to talk about, your mindset. What can happen is like you got into the trade, it started to go, you're like, Yahoo, Yahoo. But again, maybe your goal was the 50, maybe your goal was the 200. And as it starts to come back down, the mind will start to go, it's going to turn around. It's going to turn around. Apple's going to report. They're going to do good. They're going to love the earnings. The stock's going to raise, et cetera, et cetera. Meanwhile, it starts ticking lower. And instead of being up, you're now down on the trade. And maybe your stop would have been if it at 13,026, just as to use it in this example. But in essence, if it goes below that level, you may not, you're just going to start to talk to yourself and talk yourself into, it'll come back. It's going to roll. It's going to turn. It's going to go. I know it is. I got, et cetera, et cetera. Next thing you know, you're down 200. Then you're down 300. Then you're down 400. And you're still trying to tell yourself, oh, crap. Now I got to let me just see if I can get this to turn around and let's make some of this money back. So what is happening when that happens? You just broke your mindset. And let's just say it is in a down market and it's doing this. There's a point when you will recognize, if you're keeping your mindset intact and you're honoring your trade rules, that you then can look to see, oh, maybe they were done with the buys. Now they're coming in as a seller. Do I need to reverse and sell and go along with this? So again, what I'm basing this on is A, you're a day trader. B, you're not trading with a bullish or bearish bias. You have no directional bias. And if you can really get your mindset wrapped around that, you are now in a position to participate in either direction. Again, something that I heard from the previous presenter, which I 100% agree with. I can't tell the market what to do. In fact, the market basically almost can't tell itself what to do. So who is going to, or where are we going to determine direction or what's coming next or how this thing is moving? We use the price action. Who determines price action? Hundreds of thousands of traders all around the globe, all putting orders in. Asset managers putting the orders in. This one putting the orders in. A news piece that comes out. A violent change in something that's happened. An economic figure. A company reporting their earnings, et cetera, et cetera. Now, we're about 2 minutes away from here, and you can see we're just sitting, some selling, some buying, everybody's getting all set, everybody's getting ready. So, yes, it is very true. It is very important to follow your rules, but it can be very difficult. And that difficulty comes from between our own ears. Is it possible to allow subtitles? That's not a question for me. That would be for David. And I have no ideas if Zoom actually has those. So I'm sorry, I'm unable to answer that question. But back to mindset, and we're going to keep an eye on it because the earnings are supposed to come out. Now, again, here we have it that we're going to be getting many reactions. So we already see they've just pumped it up. They just brought the stock up in anticipation. Somebody's going to jump in because they think, oh, we got this. They're going to report good. They're going to blow the doors off or whatever. And here we go. Now, that's just the first move. I don't know if it's actually, yep. Now you see the reaction. This stock is treating it's very muted. So the whole reaction was 52 points. Okay, got half. Look what they're doing. So Apple, I guess, has decided that it's blowing the doors up, or it's being interpreted. So let me just go very quickly over to my others. And we're going to go over here, and I'm going to put AAPL. 152 beats 143 estimate. Not all that great, but it did beat. Now, what becomes, oh, look at that. What becomes more important is when they finally start to digest and put the rest of the numbers in it. Okay, so there's like they beat on earnings. What does the rest of the numbers show? So we get that quick response, bing, run it all the way up, bing, now we're running all the way back. Now do you understand this is a 2-minute bar? A 2-minute bar. We've now seen, oh, they're going to take it lower. Holy cow, what's going on? Now, let's go back. You've got your trade rules. If you're going to try to trade this emotionally, you will get slaughtered. So you're going to have a trade plan. How am I going to trade the earnings? What's going to be my trigger? How do I get in? How do I get out? They're no different. So you're going to have to develop what are those triggers? What are your entry points? What are your exit points? And do you really want to do this? Because within 2 minutes, it's gone up 50, come back down 50, now heading back up. How am I supposed to trade that? Well, that's your decision. So you can get cremated here very easily. And I'm just going to do one contract. Now, to me, it's more important. I could be watching this price action. See, they took it up, they bring it down. And this is just people throwing out now. They're trying to get stock. They're trying to maybe cover a short if they shorted it, or they're trying to cover the long, or whatever's going on. So we're getting all kinds of things just being tossed in the market. But to be honest with you, this is one of the most subtle that I've seen. Here it is actually right here on the stock itself. And I can take this down and put it on a 5-minute chart, open it up, and you can see 5 minutes, it ran from 166 to 171, $5, come back down mid-range. Now we're getting some ideas. Okay, how do I want to do this? Right? Now I can add some other factors, technical factors to my chart. Okay, so it ran up, it's come 50% back down, and you can see they're just going to hold and trade. They need more information before they can decide, do I buy it again or do I sell it? So what really happens, now they're reporting what they all, their revenues, their wearables, the European sales, et cetera, all-time record in services and March quarter record for iPhone. Okay, that was great, but that's the March quarter. I want to hear what Mr. Cook has to say for the moving forward, the forward guidance. One of the things is as an old market maker and as an older trader is, okay, here, that's why they brought it back down. The Q2 America's revenue was down year over year. Okay, bing, 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 bing. Okay, but now they go back up. Mac sales, okay, but the iPhone sales were a record. Ding, 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 take it up. So you're going to get reactions off of every little piece of what's going on here, and it all gets in. And they raised the quarterly dividend a penny. Okay, not all that much. iPad sales, they have a lot of different sales divisions, and they separate it all out. So this was the first thing. Oh, all they got is, and you have algorithms that are in play, and they take the news. So this gets fed into the algorithm. Beat. Oh, and it beat. Buy it. Right? And then it gets the next one. And then, oh, earnings per share. Okay. Now maybe it wasn't, going there. But then this one, America's revenue down. Ding, 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 ding. So now all of this is get fed in. Now go back. Now I'm over here. How do I want to trade this? Well, I got to be honest with you. This is one of, for Apple's earnings, And let me just say, coming into Apple's earnings, everybody was hanging their hat on this. Apple, the last thing we can hang our hat on if this market's going to be bullish. Okay, now what? Now what? Well, we got to wait another. Unfortunately, it's going to be towards the end of my presentation, but the next person up will get the press conference, Apple's press conference. And it all will depend on what the CFO and the CEO of Apple have to present and talk about. Now, if we're going to go on what we've really been seeing, these corporate earnings and these corporate CEOs have been coming out and they're really including what we're looking forward to, what can possibly start to happen. There you go. Thank you, David. So many things, but now I'm just wanting to trade. Well, I really wouldn't have. Great reaction, came back down. If you caught that, you likely wouldn't have got in unless you did it at the market. But now we're seeing them to kind of like put it all in. What does the algorithm tell you to do? Does it say to buy it or to sell it? And you start to see them. If they're just people that are just out trading and maybe they bought it and now they're hanging on, it's like, well, oh man, they're not going to really bring it back around. Maybe what do I need to do? It's going to take me right to my next section, which is the mindset. It is extremely important if you're determined that the trading is something that you want to do and you want to make it your primary source of income. Having a strong mindset is going to be absolutely crucial to your success. And what is inside that mindset that I include, that what can happen, is a lot of the internal noise. So when I'm talking about a mindset, and you could see me, you would see that I'm drawing with my hands a perimeter around my head. And that perimeter is where noise cannot penetrate, because if it does, I'm breaking my focus. What can break your focus? The trade goes against you. It gets really fast. Something unseen starts to happen. So what can also then break your mindset? You have to start having an emotional response. Like, oh my God, right? Suddenly you're in and the market's nosediving. And suddenly you're down 1,000, you're down 2,000. You're just like a deer in the headlights. You freeze. Oh my God, what's going on? And so then the next step that happens is the brain naturally now wants to process what is going on. So it's going to start to try to look, where can I find it? Where are the clues? Is there news? Is there something going on? Now you've totally broken your mindset, because now you're out looking for the news, and yet the stock is continuing, or the product is continuing to tank. Now you're down 5,000, now you're down 6,000. Next thing you know, you're blowing that account out. So I hope just by that very simple example that we're going to be understanding how important it is to block out the noise. What can I consider noise? Who, what, where, when, and why? If you're trading off of the price action and you're trading off of your indicators, mine being VWAP, value area high, point of control, etc., and the moving averages. At other times, I can add a few things to it, and then that it just layers it up a little bit. But noise is your worst enemy. You betcha. You betcha. Now, how do we deal with that? You've got to build your strength around, if you are a day trader, if you are a swing trader, or even if you're a position trader, you have to follow your rules. And as I said when I started, my rules most likely are going to be different than your rules. So again, you build your rules over what your triggers are, what your goals per trade are. And where are you going to get out if that trade becomes invalidated? So how are you going to determine that the trade is invalidated? that it's not going to happen, or it's not going to happen right now. Because the one thing you can't do is, as it starts to come down and you're a day trader and it's now gone past that point, and your brain starts saying, oh, no, hold off. It's going to turn around. Why? Because I don't want to take a $500 loss. I don't want to take a $1,000 loss. I just don't want to do it. I'm not going to do it. And now your mindset's just been broken. And you see how you can do it to yes. The weakest link is between the screen and the chair. Yep. And it does not necessarily have to be that way. It does not have to be that way. Now, we're talking about psychology here today. We're talking about discipline. We're talking about all those emotional things that we have to really, call from the United Kingdom. I don't need to answer that one. These are things that we actually do and can have control over. What we can't control is what comes into the market. Unexpected things, suddenly it just happens. Case in point, this morning, market's going lower, market's going lower. I actually shorted it at one point, and suddenly the Western Alliance Bank Corp, because the market, there were a lot of traders that they were going after, and they were pounding Western Alliance as it's like, you're the next candidate to go to have the bank failure. And the CEO purposely got on CNBC and said, these are absolutely we're fine. Everything's fine, blah, blah, blah. Next thing you know, that somebody saw that in their algorithm, turned around and popped the index 20, 30 points. Bing. Because you've got algorithms that are running and they interpret the news. And that was like, oh, you're saying it's false? Turn around and buy it. And they ran the stock $8 immediately. I mean, it had already been knocked down, but they took it right back up. What happened after that? Traders decided, we don't believe you. You guys come out and say this stuff all the time. They started knocking the stock down again, and the index came all the way back down and went to new lows. So, but it was an unexpected thing. Now, as a trader, I have enough room in what I'm doing that I caught that, but I know how to scale the order up. So I'm raising my level and realizing that I saw that wasn't going to last, because it wasn't like one algorithm kicked into gear, the next algorithm kicks into gear. And that, you see, you get out of your trade, right? But if you break your mindset, you're going to have this conversation. You're going to try to look for the who, what, where, when, and why. You're going to go all over the place. And meanwhile, you're either getting back into your favor or it's killing you. How do we prevent that? Because you have solid trade rules. One feeds the other. If you honor your trade rules, your guides, what you're going to do and how you're going to do it, if you honor them, live to trade another day. If you break them consistently, you'll blow out your account. And again, I'm telling you, I have a lot of people that come and they want to give this a try, and their intent is strong and it's really good, but now they have to build the knowledge. Now they have to build the mindset. Now they have to have a plan. And that's where I, as a coach, come in, because again, having all the years experience, developing all of that, well, part of what I like to do is to teach it. And it's important. It's important to have that. Without it, you're just going at it blind. Then, folks, I'm going to tell you, if that's how you're going to approach the market, that is gambling. And sometimes you hit it right, and you suddenly make $1,000 or $2,000 on a single trade. Now your mind's going like, wow, that was pretty easy. Let's go do that again. And maybe the next trade, you do it again. Now you're getting like, oh, I got this. Third time you do it, the market turns and goes the other direction and does it so fast, you've just given everything back plus. So I continue to say, yep, you might get lucky. Yep, it might work for you. But I tell you, consistency is going to come when you have a set of rules, trading rules, a trading plan, whatever you want to call it. Write it down. So do write it down and follow them, because now your mindset is, now I can focus on what is my signal, what is my trigger. And as soon as you get that trigger, you already have in your head where's my goal. For me, I'm a scalper. I love to scalp. It's fun for me. Okay, I'm going to try to make $100. If I'm catching a big enough mood, it's going to move faster. So I'm going to get 150, 200, maybe 300 out of the one trade. I also have, because I can watch price action, and I've watched it long enough, that when you've got that experience, you'll know when to fade, when to kind of build, when to just hold out a little bit longer. But through that, all of that, I do have a maximum that I'm willing to put on the table. And if it goes beyond that, I'll close the trade. Now, that might be right at the point that it's going to turn. But guess what? Because I've honored my trade rules, because I've kept my mindset together, I can re-enter right away. Right away. But if I don't, and I break my mindset, and then I have to get out, now I'm angry. I'm like, oh man, this is, either you're going to start to revenge trade, or you're going to start to do something that isn't going to function for you very well. So we need to smooth all that out. That's all the noise that I'm talking about. You need to develop a barrier around your head so that the noise doesn't get into the ears, which gets into the mind. And if it's coming in internally, you don't want that trigger that's going to bring you to a point of anger, that's going to bring you to where you're going to start doing something that you don't want to do. And in my trade room, by the way, when I get in a trade, I tell people in my trade room, I said, here's a clue. If I get into a trade and it starts to go against me, and the first thing that you hear out of my mouth is that I put out a cuss, I'm telling you, everybody, tell me to close the trade. Because obviously I just moved to a level that it's like, you're not into your mindset. You just broke your mindset because you allowed anger to jump in. So the question coming back is that, so you let your stop hit, then re-enter when favorable. Yes, that's one way of putting it. But what I'm really making reference to that is if I'm working the trade and I'm building the trade, because that's where my experience comes in, and I know exactly what my level is. Is it going to be $2,000? Is it going to be $3,000? Again, because of the account size. If you're working an account, a $50,000 account or a $100,000 account, you don't want to take a $3,000 to $5,000 hit. That's too much. So you got to tailor that down. So let's say that you've got $1,000. That would be your max. You're working a $100,000 account, and so you're going to risk $1,000 on one particular trade, and you can work it. But if you do not get out, as you're telling yourself, I'll risk 1,000, and if the market takes it up and takes that 1,000 and you don't get out, you just broke your mindset. But if I'm keeping to my rule, which is that's all I'm going to risk on this trade, I get out. Now I'm not moving to anger. I'm not moving to anything else. I'm now still focusing on the market because I want to do the next trade. And possibly the next trade is doing it the exact same thing. Let's say, for example, I was short and the market went up, hit my limit. I got out, but that was also when the buyers were done. And now the market's going to start heading back in the other direction. Well, I want to be of a clear head so that I can get in. I know it's like, Joe, it's like, I want to trade Forex futures. What pairs do you like that trend better? I am very similar to the previous. I don't trade Forex. And most people want to trade Forex futures because they tell you can start with very, very, very little money. I don't think you can start in any, particularly with pairs. You need to understand what motivates and where and how that pair, whatever you're choosing, trades. For example, a big pair is the dollar euro. Another big pair is the dollar Japanese yen. I've seen other pairs where it is the Australian dollar against the New Zealand dollar. These are strong pairs that have consistent patterns. Then you have to plug that in to what indicators are you going to use that are going to tell you when to get in, when to get out. Because each one will move individually, right? Maybe the Japanese yen is going to be big on that day. Maybe the dollar is the one that's going to be big on that day. How does that affect the other markets? So because it's such a big, gigantic market, and there are as many reasons for central banks, individual banks, big trading firms, et cetera, to go in and trade in the futures and in these crosses, and how one cross affects another cross affects another cross. So a lot of it could be hedging. So you need to really learn about what you're doing. But what pairs do I like that trend better? They all trend. But you need to study them, and you need to realize, okay, which ones are trending better? Well, the strong one that I would notice would be the dollar euro. And doesn't mean that it might trend intraday, but the volatility in the dollar has been incredibly strong. And we can go up and down a lot, 50 cents, $1, or whatever, quickly, and against the euro. But then it can reverse. So if that's what you're asking, stick to the one that you know. And that would be like, for me, if somebody was saying, you've got to trade a pair, I would probably choose the dollar euro. But that doesn't mean it trends wonderfully every day. So again, what are your trade rules? Are you able to follow them? Are you able to implement them with success? Are you able to use them without emotion? So again, mindset, building a strong mindset, is invaluable to you. And again, let me just say, I am far from perfect. And I get distractions while I'm trading. I get pulled over to this market, I get pulled over to that market, or I'm trying to watch, for example, I'll just show you. And by the way, they're all waiting for the press conference now. You can just see stock is sitting nowhere. It's up a little bit. There's this. Any other time, if Apple wasn't the last one, where they're hanging the hope on, it still would be going crazy. Here we have gold. Gold has been incredible. So I'm going to just put it up on a 60-minute chart, because I've got to show you. Oh, this is it right here. Here was yesterday in Globex. Globex opened, right? So Globex for me opens at 3 o'clock in the afternoon, 6 o'clock Eastern. They opened it and they ran this thing. I think that was the actual Globex open. And then the next one, they just went, oh my God, they took it up to 2085, 2085.50 actually. One swing. Now this is $10 a tick, $100 per dollar move. And they ran it. That can ruin your day real quick. So having a strong mindset is vital. And I'm just going to try to tie this all in. So really what I'm presenting here today, you start with your trade plan. Figure it out. Put it together. Write it down. Be comfortable with it. Be able to use it. Know what your triggers are. Know everything. If you're going to use a moving average, go study them. If you're using a candlestick pattern, go study it so that when it happens, you understand it, you see it, you notice it, you react. The point about being a trader is you really are trying to remove your own emotions from the equation. That's what can throw you off. So you're going to see some of the best traders. Again, I was a floor trader. I stood in a pit of 100 people screaming and yelling. But the one thing I noticed is that I always looked at in my early years, I looked at the traders that were unfazed by the noise, by the movement, by anything, and they could hear people from across the pit. How? Because their mindset and their focus was totally tailored, and they knew exactly what they want to do. They saw the position, they put the positions together, and they were very, very successful. You need to do the same thing, whether you're trading a future, whether you're trading a Forex pair, makes no difference. I'm going to be good because I tend to go over on these. So I'm going to quickly say if there's any questions, I can answer a few questions. Otherwise, I'm going to turn it back over to David, say thank you very much for joining me this afternoon. Thank you for listening. And David, thank you very much for including me in today's program.